host Shravani and welcome to our podcast What's the Plan? As we see equity markets reaching all-time highs and traditional asset classes as well becoming increasingly expensive, investors are trying to look for newer products and better risk-adjusted returns. So, one such product that has been gaining attraction is MLDs or Market-Linked Debentures. In today's episode, we will be trying to breaking down what MLDs are. So I have Mr. Vishal Dhawan, who's the founder and CEO of Plan Ahead Wealth Advisors. He will be helping us trying to understand what MLDs exactly are. Hello, Vishal.
Thank you.
Yeah. So let's get right into it and trying to explain our viewers what MLDs exactly are and why are they viewed as such a complex yet intriguing investment avenue by many of the investors out there.
So I think what tends to happen is whenever you have hybrid instruments coming together, there is complexity which accompanies it, because a lot of people, by the very name of a market-linked debenture, are confused because traditionally debentures have always been thought about as bonds, and
Right.
because they are in these, a lot of these are also listed in a certain manner, and their performance may be linked to equities. The market-linked debenture creates its own complexity as a name.
Sure.
So these are created under SEBI debenture regulation,
Okay.
and essentially they've been put together with different kinds of mixes, depending on what investors are really looking at. So they are interesting products for investors to think about and to consider as well. But I think the understanding of that may be a little limited. They're very popularly known as structured products globally,
Okay.
but their outcomes could be based on a series of different factors. And I think that's why there's a need to dive deeper into the type of MLD you want to invest in before you make a decision.
Okay, sure. Now that we've understood the basics of what MLDs are, let's try to focus on what kind of different MLDs are available in the market right now for investors to look at, and who exactly is the target audience for these MLDs who can look at these MLDs as an investment option going ahead.
So typically MLDs can be in two forms in its most classical format. One is where they are principal protected. Of course, the principal protection is subjective, and I'll come to that in terms of what I mean by a subjective principal protection. And then you have non-principal protected products. So the most common example of an MLD is where you have a equity index like the Nifty 50, where depending on how much that index goes up or goes down, the rate of return that you as an investor get, either on maturity or at some point prior to that maturity, changes. And typically in a principal protected product, the way these products are designed is that they will tend to have lower upside because you're being given some sort of downside protection by default. So let's say they could tell you that, I have a minimum 6.5% outcome if equity markets fall, but if equity markets go up, maybe I will give you participation only to the tune of a certain smaller percentage.
Right.
Whereas in a non-principal protected product, you could have a situation where if the time that you invested in the MLD was X, the index was at X, and then it falls by 50%, they will not be able to give you back even the principal. So essentially the structure could vary. The important part around principal protection in a MLD is to keep in mind that MLDs are issued by institutions which could typically still have credit risk associated with them. And therefore, even though you may believe that principal protection means that your money is safe in all situations, that is not the case, because whoever is issued the MLD could still end up defaulting because that money could have been lent out maybe as an NBFC or in any other place. And there are implications of that come up. And therefore, that's why I mentioned that it is a subjective principal protection, not an absolute principal protection, the way that investors may imagine principal protection to be.
Sure. So MLDs are like an interesting blend of market participation and debt protection as well. And Shwani, like you pointed out, there are a few risks as well. So, if you could just, for the benefit of our investors, jot down some potential pitfalls that they have apart from the ones that you mentioned, along with the benefits that can be helpful for them before taking the decision of buying such products.
Absolutely. I think, I must re-emphasize the default risk item because I think it doesn't get enough attention. I think what tends to happen with an MLD is the focus is normally on the structure, saying that 30% participation on the upside, 50% participation on the downside, etc., etc. But not enough people focus on the fact that this could actually have a direct implication if the issuer of the MLD itself defaults. The other thing that can happen is that you are taking a directional view in terms of where the markets are going to go if you're buying an equity-linked debenture, for example.
Okay.
And therefore, if your view is that the markets are going to go up, and therefore you take a MLD which will give you a higher return if markets go up, and markets actually go down, then the outcome could be different from what you were anticipating. And therefore, they are very clearly what I would call view-based products. So there may be a view that you have to which you are trying to apply a structure, and say that what product is best designed to bring my view to the forefront, and therefore investors need to be aware that when that view goes wrong, the MLD may not deliver the kind of outcome that you would want it to deliver.
Sure.
The third thing is that even though MLDs may be listed, they don't have a lot of liquidity, and what happens with most MLDs is that they are not giving you regular coupons like bonds do. So there's no regular interest coming in. All of your money keeps potentially accumulating in the product itself. And therefore, number one, they're not designed for cash flow. And number two is that because they are accumulating all the interest and the coupon and whatever else within the product itself, you're never really getting any money out of it till maturity, which again means that you are exposed to the risk that if there is a default somewhere along the way, you have not got any money at all in this whole process. The other thing you need to keep in mind is that because they could be relatively long term, they could also be subject to some sort of interest rate risks in the way that they are structured. So there could be a bunch of different risks that investors take on.
Sure.
At the same time, we need to keep in mind that they do come with benefits to add on to core portfolios, which could be equity or debt oriented in any case. And therefore, one doesn't need to look at them as a standalone solution. One needs to look at it as a part of an entire portfolio.
Okay.
And the moment you put it as a part of an entire portfolio, you may say that depending on whether an investor is more conservative or less conservative, some of these options could actually come through, and you could actually add it in as a top up into the rest of your portfolio.
Right. So that sort of tells us what risks are and what benefits do MLDs provide in general. So let's look at a question now that's always been on the minds of most of our investors. How does the tax treatment for MLDs look like, and how has it evolved over time?
So I think the April 1, 2023 provision that came in on MLDs was actually a big changer in terms of what and how MLDs are going to be taxed. So before that, if you held an MLD long term, you were taxed at capital gain rates which were long term, and therefore they were very tax advantageous. Post April 1, 2023, that provision changed, and now there is no tax benefit available in MLDs, which means it gets taxed at your marginal tax rate. Unfortunately, what happened in this tax provision is that there was no grandfathering provision, which meant that even if you had bought an MLD prior to April 1, 2023, as and when it matures, you will be taxed at the marginal rate. Okay. So I think to that extent, MLDs are not as tax efficient as they used to be. They still have a place in a portfolio, but not because they're more tax efficient. I think they have a place there because they can be an interesting combination to a view-based approach on top of your equity and traditional fixed income portfolio.
Sure. So I think this brings me to my last question. Now that we've discussed about what MLDs are, their benefits, the types, and the tax advantages as well, how should one look at this product in terms of incorporating it into their financial plan or into their portfolio strategy as a whole? what sort of an holistic view should one take, and how do they go about that?
So I think, traditionally MLDs were designed for more high net worth and ultra high net worth individuals because MLDs came with very large minimum ticket sizes.
Okay.
More recently, that number has changed, and you can now buy MLDs at as limited as 10 lakh rupees for an MLD, which is meant effectively that it is an option for putting into portfolios which may not be as large as they once upon a time used to be.
Sure.
Now, of course, issuers may still have different thresholds. There may be certain players who want a minimum 10 crores or 1 crore, 50 lakhs, 10 lakhs, etc. But in general, there is a little bit of ease now if you are able to wanting to participate into an MLD. The important part to keep in mind here is that because they do not have liquidity, even though they may be listed, they cannot form a part of a bucket where you are expecting that in certain emergency situations or in certain cases where your view changes, you want to be able to liquidate, because you may find that there will be no liquidity available.
Sure.
So it's important to be clear that you will not require this capital till the point that it actually comes up for maturity. After you've done this level of thinking, I think it's important to understand the role of the MLD in your portfolio. Is it coming in as a debt plus instrument, which means that you're trying to do slightly better than debt, and therefore the kind of MLD that you will buy will typically give you a debt sort of return, but with an upside if the equity behaves in a certain manner, or vice versa? Are you looking for something where the derivatives that an MLD uses are going to result in better outcomes if equity markets do well? And I think once you're clear about what is that role of the MLD in your portfolio, that's when you put it in. I think it's good if you look for rated MLDs as well, because there is a rating that gets done on MLDs on top of that. And like I mentioned earlier, be very mindful about who the issuer of the MLD is, because that's your biggest risk in the form of default or credit risk that might emerge in case something actually went wrong with an MLD.
Sure. Such an insightful conversation, Vishal. Thank you so much. Brings me to the end of this episode. Thank you so much for joining us and explaining and demystifying the world of MLDs. So, market-linked debentures, I think they are the right product for you, given you understand how they work and the risks that they come with. So they can be looked as a product for better risk-adjusted returns and diversification basis your view, of course. So that brings me to the end. Thank you for tuning in. Thank you for being through this episode. So if you like this episode, please do consider subscribing to our YouTube channel. Thank you.
Disclaimers. Investments in securities market are subject to market risks. Read all the related documents carefully before investing. Registration granted by SEBI, membership of BUSL and certification from National Institute of Securities Markets, NISM, in no way guarantee performance of the intermediary or provide any assurance of returns to investors. The information is only for consumption by the client, and such material should not be redistributed. The securities quoted are for illustration only and are not recommendatory. This material is for information and educational purposes only.